Good day, everyone, and welcome to our 2024 annual letter. It's really been a great year for the Peregrine Capital Funds. Our high growth fund ended the year up 22%, and our pure hedge fund ended up almost 16%. And it's a year we're really proud of, especially given the difficult economic events we had to navigate. All of you will know that South Africa had elections last year, and it was really an unbelievable outcome for the country, with a government of national unity formed after the election, with ANC and the DA as the major parties. And 6 months later, we're pleased to say that the government of national unity has stuck, and I think it's largely moved the country in the right direction. We haven't yet seen material change and economic activity on the ground as a result of the election, but I think the biggest changes one's seen is certainly on the load shedding side, where we've now had 300 days without load shedding in South Africa. And I think there's also other positive signs of policy moving in the right direction. I think, on the other hand, there are still clearly some issues. We still have a high national deficit, which the government has to try to work down over the next year or two. And additionally, things like water infrastructure are clearly lacking. And again, things like the NHI regulation are still in the pipeline. So we're not completely out of the woods, but it's certainly looking a lot better than a year or two. And I think we as a fund, took really great advantage of the low SA valuations on the JSE before this election, and that was really a meaningful contributor to the return this year. I'm going to hand over to David to discuss one or two of the ideas we've taken advantage of in South Africa in the past year.
I think one of the highlights of the year was the buying out of Steinhoff of our preference shares. Now, just to go back to 2017, when the Steinhoff debacle was first brought to light. I mean, again, as you say, how could we possibly have made money out of Steinhoff? And again, very similar to how we made money out of African Bank, which, if you recall, was a failed bank. And again, at that scenario, we looked very hard to see how we could potentially make money. And we identified the African Bank Euro bonds that were issued on the European Stock Exchange. And once again, similar to what happened in Steinhoff, these bonds were effectively sold off very aggressively. And at the time, we realized that African Bank had no equity value, but the bonds would be pretty much made whole. And we took quite a big stake in the African Bank bonds. And over time, we actually pulled ourselves to par, which was a very successful outcome for us. Back in 2017, when the Steinhoff scenario broke, I mean, clearly all investors were heading for the hills. Nobody wanted to own anything that had the name Steinhoff in. But certainly we did quite a lot of active work and understood where the preference shares sat in the capital structure. And very quickly we understood that it sat in the SA holding company that didn't have any of the debt that was captured in the offshore holding structure. And we realized that it also had the investment in Pepkor, which we understood the company very well. And we knew that our level of cover in the preference shares was a high multiple of the capital value that we required. So we realized that the risk in the preference shares, even with Steinhoff collapsing around it, was in fact very low. And I mean, it proved out that way. In fact, the preference shares never actually missed any dividend payment. If they had, we would have had step-in rights to be converted to equity, and we knew they wanted to avoid that. So those preference shares were in fact a very safe instrument with a multiple of capital cover that we required. We certainly held them. They were actually suspended for a period of close to 3 years during that period. So again, you know, the ability to understand the instrument better than most, to do the hard work, and to have the conviction to hold through the period really stood the funds in really good stead. And then early last year, we were approached by the company to buy them back, which again gave us a nice liquidity event and helped us effectively realize our full capital value, as well as getting our running yield over the period. So again, a specific instrument that was very much uncorrelated to markets, that again, similar to the African Bank bonds that we bought many years ago, was a specific opportunity where we did hard work and we understood the position better than most, and really did well for our shareholders over that sort of 6 or 7 year period.
And I think it's interesting to me how long this thing stayed mispriced, and which really shows that very few people do this work. I mean, we bought our first shares, I think, at 20 Rand or 20 cents in the Rand. I think we bought some at 30, some at 40, even in later years at 50, 60, 70. And in the end, we got 50 Rand of dividends and 98 Rand in settlement. And I think it was just such a great opportunity for many years.
Yeah, and I think we kept buying throughout that whole period, if you remember,
Yeah.
Jacques, even from the 20s, the 30s. Obviously, for the 3 years it was unlisted, it was difficult too. But then when it came back in the 60s and 70s, it was there for a long time. And we continued to sort of buy back or continue to build our stake, knowing that eventually we were going to be, there would be a liquidity event here.
I think it's maybe an interesting one that it ties up to another position we've had in the funds for a long time, being Pepcore. That's been a business, a SA retailer we loved and we've held for almost 3 or 4 years since it's been listed. And I think last year was a particularly good year for that one. So maybe just give us some of your thoughts on that.
Yeah, I mean, I think Pepcore is just a phenomenal business at the low end of the market, and it really does. I think they've executed particularly well over the last 18 months. And again, with some sort of recovery in consumer spending, Pepcore has been a really good performer. I think we've cut our position back quite significantly. It hit our sort of fair value target. And again, once again, we need to reiterate that when shares do hit our fair value target, we are sellers of them, even though we may continue to really like the business. And I think that's a case in point in Pepcore. It probably just got to our target valuation and we cut back the position.
I think it's a nice example of how we're willing to be patient. I think we held that kind of for several years when the valuation was cheap. We sat on it, and sometimes it all plays out in 1 year. And I think it had a huge performance last year. I think one other share I think it's worth talking about that we spoke about in 2023 as well was Fortress. You'll know we did a lot of work with the company and with shareholders in 2023 to try to simplify the capital structure. And I think in our letter last year, this time, Justin and I discussed the fact that it worked out so nicely in 2023, but we still thought a lot of value unlock was still to come on the simplified capital structure. And it's pleasing that the market saw the value here. If we look at Fortress excluding NEPI, so basically the kind of the SA or the real property portfolio, that was up more than 100% last year. Certainly benefiting from some SA sentiment post-election, but I think also just the market seeing the value now the capital structure was simplified to one share. And I think one other trend that still has me very excited, it's been a regular theme on our letters, is artificial intelligence and just this mega trend. I mean, we still think this is the defining invention of our era, and we think it's going to just massively change and impact the world that we live in over the medium term for the better. And right now, we still think the best way as investors to play this is to own these large technology companies in the US. The way AI is played out is you need huge pools of capital to build these massive data centers to train these AI models, to run these AI models, which means these large tech companies, kind of Facebook or Meta, Amazon, Microsoft, Google, are all the best positioned players to build this and to benefit from this. They all had spectacular years last year, both on the earnings growth side and also on share price performance. We think they're a bit more expensive than they were about a year ago this time, but because of the strong earnings growth, we still think they present great opportunities in the years to come, and we still have meaningful positions, even though it's been a good contributor for a few years. I think, David, it would be nice to hear some of your closing thoughts about the business or SA or markets as a whole into 2025.
Yeah, I mean, it's obviously difficult to look forward. I think that we'll be faced with lots and lots of challenges this year. Trump just got inaugurated yesterday, so I think it's going to be an interesting time from a news flow. But when I look at the portfolio, I really feel that very comfortable that we're appropriately positioned. I think we've got some nice positions in a few different diversified markets. Our South African exposure we've cut back because of a valuation scenario. And I think the South African scenario will be very much data dependent from here on. As you correctly point out, we've had a really good outcome from the election, but we need to now see whether the data comes through and whether the reforms that we see are actually implemented. I mean, again, some very good early signs from Transnet that in fact, what they seem to be doing there with the new management team seems to be working well. And these are all very positive signs from South Africa. I think from here on, it's going to be data dependent. Can we actually put this thing home? Can we create some jobs in this country? And can we grow this economy? But if I look at where we are, I think we've got a nice diversification across geographies and across sectors. I think the business is in great shape. We've made 4 very key hires in our front office of good, young, enthusiastic people, and we look forward to them committing this year. But I think the business overall is in very good shape. I think the portfolio is in good shape. But the predictability of this year, I think, is going to be an interesting year. So we seatbelts on and let's see where we get to.
Great. Thanks, Dave. And thanks to you, our investors. Thanks for listening in. We appreciate your support and your long term backing of us, and we're certainly going to do our very best to keep putting good returns on the scoreboard.